Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Feels kind of mellow this Monday after Thanksgiving, and it's not like there's a Fed meeting in a week and a half, Tim.
Is everyone just they're bringing turkey for lunch, for leftovers?
Yeah,
and they're falling asleep at their desk because of the ingredient in turkey that makes you fall asleep. Supposedly, I don't know if that's true.
It could be. I don't know. Maybe.
You watch any football?
We didn't really watch football.
I was in Ohio, so we had to watch the Ohio State-Michigan game.
For your wife.
For my wife, for everybody in her family, for anybody you walked into, anybody you ran into in the entire state, if you were walking down the street. That's how it works there.
It's a big football state.
Go Ohio State is what I have to say.
Well, it was a lot of football this past weekend. Let's though talk a little bit about the markets, because we've been bouncing around here and it does look like we're counting down to next week's Fed meeting. With us right now is Doug Sioka. He's Chief Executive Officer, partner at Kavar Capital Partners. The firm has about $1.6 billion in assets under management. He joins us from Leawood, Kansas. Doug, there is so much going on, so many important things. You've got that next Fed meeting, next Fed share, the spend on AI, the crypto fallout, so many important things. But we've got to start, Tim, with what's really the most important thing, and that is the Kansas City Chiefs. We got to ask, they're in danger of missing the playoffs for the first time in more than a decade. They've been in the last 3 Super Bowls. I'm always rooting for them. I love watching them play. They always come back, yet this year seems like it's something different. How painful is that for you?
It's tough. It's more painful to hear Tim rooting for the Ohio State Buckeyes.
Come on.
Than it is we still have a lot of confidence in our Chiefs. It's funny, and maybe a lot of like markets, there's mean reversion that tends to take place. And the Chiefs have lost 6 games all within 1 score. And really the last 7 or 8 years, they've seen win all of those 1-score games. So they may have used up some of this year's luck in prior seasons, but we still have a long way to go. I think if they can win 10 or 11 games, they have a decent chance to get into the playoffs. So we're still hopeful.
Wow.
He's hopeful.
What's easier, the market, the equity market continuing to move to the upside, or the Chiefs actually getting a chance at another Super Bowl?
Hey, the stock market, and we wrote a piece a couple months ago that just talked about these all-time highs. And certainly there's an obsession about where we go when you get to those inflection points, which is defensible, right? But, it's how could we not be at all-time highs when we have earnings growing as fast as they have? We have a Fed that's in a very accommodative posture. We have low taxes and regulation. And we're in the midst of one of the greatest ever, tangible technological revolutions our country or the world has ever seen. So we're not too terribly surprised that we're at all-time highs, nor are we too terribly surprised when we see a little bit of consternation and maybe some intermittent volatility that transpires around these levels.
So let's broaden this out a little bit and think about the people who are in control of interest rates. And that would be, of course, the Federal Reserve. We spoke with Christina Lee a little earlier. And it seems like, Carol, people are pretty set on the fact that it could be Kevin Hassett. The president has said he's made a decision.
Yeah.
We just don't know who that is.
No.
Kevin Hassett as Fed chair, does it change your view? What do you make of it?
We knew whoever President Trump was going to pick was going to be very dovish. And Kevin certainly came to the top of almost all lists over the course of the last couple months. I didn't think anyone ever thought Mirren was going to get the nod as the chair, because he likely would never get confirmed. Kevin Warsh seen a fall off the table, going back to the Fighting Irish. I had a soft spot for Chris Waller, since he used to teach economics at the university. But I think Kevin Hassett would be a very good choice. And I do think, the Fed wants to cut rates. Carol mentioned on the lead-in, we've got a Fed meeting in the next week and a half. I think that the Fed, we've got this theory that they're in this triangulation of Fed tension, right? As I mentioned, we have a really strong economy, but it's very uneven in its benefit distribution. We have a fear of excess liquidity if we see a lowering of interest rates, but it's also at a time where there's a very, very significant cohort of the consumer that is dying for a little reprieve with lower rates because they have floating rate debt, because they have jobs that don't keep up with the cost of living in the increasing price of things, because they don't have money in the market, right? And then the third thing is we have this incredible technological revolution. It's ubiquitous in its industry application and it's unprecedented in its efficiency elevation, but it's exacerbating unemployment, right? So the Fed really is at a consternation point. I think they do want to cut rates. They've talked about doing it as an insurance cut. We think of it more like a cohort cut to a certain very important part of the underlying consumer.
Well, what does the path look like beyond December then?
Yeah, that's a really good question, Tim. I think again, maybe that comes back to Hassett, where, interestingly, President Trump had said for a while in some of his denigration of Chair Powell that, shoot, we need to be closer to where Japan is and Europe is, and we need to cut rates by 350 basis points. Well, if you look at the bond market this morning, we're in the midst of one of the biggest sell-offs we've had in the last couple months because there was an expectation overnight that Japan is going to hike rates. So if we have sort of a monetary policy that's not globally coordinated, that could create a little more consternation in fixed income markets, but it could underscore the need for the U.S. to be a little bit accommodative, more so than we otherwise would have to be if the rest of the world was on the same page.
Hey, I want to go back to, though, I don't disagree. I think a lot of people don't disagree that when you look at the K-shaped economy, that there are many folks that are struggling in this economic environment. And you're right, Doug, they're not in the equity markets. We now are talking about the three A pillars, whether it's, asset prices going up because of the spend on AI, and that is making the rich people even richer, affluent. And so, they have a lot of money to spend. And we know the wealthier consumer is really important to the overall consumer spend. Having said that, society-wise, socially, it's important, right, to take care of all citizens, because there's a lot of Americans that aren't in the equity market. Having said that, the Fed's mandate is to watch inflation and to watch the labor market. And is there a risk if they go on a trajectory of cutting rates? If they just do it in December, do you think there's any risk of creating some excess liquidity in a market where you say earnings look good and there's a lot of good stuff out there? So is there the possibility of a risk, and who knows how that plays out and what kind of a crisis? Maybe none, but I just wonder.
I don't know if it's crisis-like, Carol, but I do think, again, this goes back to this tension that the Fed is really walking a tightrope, because to your point, I do think widespread prosperity is one of the things that makes our country so special, with that expectation that it is within reach for full participation. And I think the issue becomes, like, if things just become unaffordable, that you're helping this important cohort with one hand and you're knocking them back with the other. So that's the part where they unfortunately have a pretty blunt instrument. Yeah. But there might be other ways, right? Whether that is just balance sheet management and things along those lines, right. Whether that becomes some of the onshoring that takes place with fiscal policy incentives to increase employment, because it is a really challenging time without question.
No, and listen, totally agree. The wealth has to spread out to a lot more folks across the country. Doug Sioka, always appreciate it. Kavar Capital Partners.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Let's get now to developments in AI and big tech. As the king of AI bellwethers, we're talking about NVIDIA, invested $2 billion in chip design software maker Synopsys as part of a broader engineering and design tie-up, aiming, Tim, to infuse its AI computing technology into more industries.
With the tech roundup, we head to the Bloomberg News studio and bureau in San Francisco, where we find the co-host of Bloomberg Tech, Ed Ludlow. Ed, why is NVIDIA doing this? Why now?
Yeah, I guess there's a question of why is NVIDIA doing this, and then what does Synopsys get out of it? So like Synopsys makes the software by which chips are designed but also validated. So before you send a chip through the fab to be manufactured, you want to know that that design works, and that's a big part of what Synopsys does with all kinds of tech companies. And so part of the interpretation of why is NVIDIA doing this is it's a sales channel, because Synopsys is basically saying, imagine how good our software would be if it was underpinned by NVIDIA's GPUs and NVIDIA's catalog of software, which largely it's called CUDA-X. It's basically a library of building blocks for AI that just make existing software platforms better. And so the next thing you're going to ask me about is probably circular financing. But from NVIDIA's perspective, it gives them entry to a tool or a platform that lots of people are using.
So, circular financing? I mean, come on. Like,
Carol did it.
Is it just getting crazy? Or is it real? I don't know.
The parties on this specific deal, NVIDIA and Synopsys, would say this is not circular financing in the same way that the graphic you're showing to our video audience illustrates. There is no requirement that Synopsys purchases from NVIDIA's GPUs. Additionally, and this is all according to NVIDIA's CEO, Jensen Huang, who was speaking this morning. Additionally, as I said, Synopsys does business with all kinds of chip makers. And NVIDIA also does business with other makers of chip design software. Siemens is one, for example. And none of that's going to change. Everyone is free to carry on as they want. And it goes back to the why is NVIDIA doing this? This is an area of the technology world we call electronic design automation, EDA software. And a lot of people feel that those systems which have historically been run on CPUs, old engineering platforms, could be a lot better if they were run on GPUs or AI accelerators. They're just better pieces of software as a result. But there are loads of players. Now everyone's free to have better software, is how NVIDIA would put it.
But why? I mean, Synopsys wants to have NVIDIA as a customer, right? So why did they need
Correct.
to, what does that $2 billion investment do? Right?
So this is highly analogous with the Intel situation, and it's highly analogous with the Nokia situation. And so this year, I've had two specific opportunities to ask Jensen Huang, what's the rationale behind taking a stake? Why do you need to own between 2 and 3% of these companies? And his answer is always, I thought it would be a great investment and that in the future that investment will pay off. So NVIDIA got these Synopsys shares at $414.79 a piece. The stock's now higher than that. I can't see it on the screen. $440 a piece. But I remember back in October when we were in DC, I asked the same question of Jensen, why did you have to take almost 3% of Nokia? And he was like, well, it looks like a pretty genius move now, doesn't it? Because Nokia shares are up 20%. And I just in the moment, I couldn't believe that was his answer. But he genuinely believes that it's going to be a great investment because he sees those engineering partnerships changing the respective fields that they're going into.
Okay, Ed, we only have 3 minutes left, but there's two more stories we want to hit with you. One is DeepSeek, because China's DeepSeek unveiled 2 new versions of an experimental AI model that it released weeks ago. It adds fresh capabilities the startup said would help with combining reasoning and executing certain actions autonomously. I'm old enough to remember earlier this year when a DeepSeek update comes out and tanks shares of NVIDIA. We don't see that, and we haven't seen that. Where is DeepSeek when it comes to competition?
Okay, so DeepSeek v3.2 has been out for a number of weeks now in the form of DeepSeek v3.2 EXP, experimental. They just dropped the EXP bit. And it's an open source model that against benchmarking performs very well against GPT-5, OpenAI's latest model. Where they've made a difference in this open source world is that, like OpenAI, DeepSeek wants to make the tool more useful. So they have the human reasoning element. It parrots the behavior of a human, but it applies the tool in a more useful way. Markets reacted in January through April the way they did because they didn't understand how DeepSeek had achieved that performance for a model at the low cost point that it did.
Does the world need to be worried? Or I guess, how does this fit in? How competitive is it, real quickly?
It is competitive.
Okay.
Models at this scale have tens of billions of parameters or more. And what DeepSeek did is called mixture of experts, or MOD designs, where if you have a 100 billion parameter model, when you run the inference, you actually run it. You don't need to access all 100 billion parameters. They found a way of just accessing, say, 10 billion parameters or 60 billion parameters, which makes the cost of running it and the compute much more efficient. Yeah. So the model is as performant, it's just easier to run.
I do feel like everything's now about efficiency in terms of power use and just getting things done. Hey, what do we need to know about Masayoshi Son, the SoftBank founder, who said he wouldn't have sold off NVIDIA shares if his company had unlimited money to bankroll its next investments in artificial intelligence? Is there something important here that we should acknowledge?
All you need to know is that he wishes he hadn't sold it, but he didn't have enough money. He needed more money. So he sold the thing that could get him money, Nvidia shares, and then he used it to invest in the thing he thinks will make him more money in the future, OpenAI. And it's as simple as that.
All right. I love when
Even
things are
he
simple.
next more money.
What does that say? How about buy now, pay later?
It's just society. It's just the world we live in, Carol.
Everybody needs more money. All right, going to leave it there. Ed, always glad we can go around the world of technology with you. Ed Ludlow, of course, he is co-host of Bloomberg Tech at Bloomberg Television. Catch Ed and Caroline Hyde, 11 a.m. Wall Street time every Monday through Friday on Bloomberg TV.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, a Bloomberg opinion piece grabbed our attention today. Paul J. Davies, he's based in London. He writes that, quote, the lack of transparency in private credit is one reason that investors and journalists could be more fearful than is warranted by historical performance. But there's illuminating data, from analysts and ratings companies that show the outlook for repayment problems and bankruptcies isn't great. In fact, it's getting worse.
That again from his column. Davies goes on to write that he's, quote, talking about junk-rated loans made by private credit funds to mostly mid-sized companies, often used to fund private equity buyouts and similar to the leveraged loans that banks underwrite and sell to investors. To be fair, there's a lot of questions that have emerged in recent weeks about private credit, and we have yet to see kind of a systemic issue or problem. At least that's what we hear from a lot of the voices we talk to.
Let's bring in Christina Lee. She's managing director and co-portfolio manager for U.S. private debt strategy over at Oak Tree Capital Management, a firm that's got more than $200 billion in assets under management. Welcome. It's good to have you.
Well, thank you so much for having me here.
You must have been watching the events over the last few weeks with great interest. And I'm wondering just your view on the chatter around greater concerns when it comes to private credit. And again, I'm using the term like, a monolith, but not all private credit is the same.
Yeah, I think it's been called the Great Cockroach Wars, you name it. I think one of the issues that I think people are having is there's been some high profile bankruptcies that have happened recently. And people are saying, is this systemic? Is this a pattern of what's next? I think sometimes you do have to take a step back and remember we're doing sub-investment grade credit. You are taking risk. There will be defaults. There will be restructurings. You don't get 8 to 9% all-in yields by not taking risk.
Okay, so having said that, when you guys, especially, in terms of private credit, I think what really tripped a lot of investors or investments up in the private world, private credit, private equity for that matter, is that there weren't the exits that were normally there, right? We've seen them pushed off, and I think it's starting to come back. But then you had terms renegotiated. You just, all these things started to happen, and you just wonder whether it gets a little bit fuzzier and that there is more opportunities or more touch points for things to come undone. Roll that in and how we should be thinking about that part of it.
I think defaults have been very, very low in private credit. And if you were to look at various managers, their loss ratios, et cetera, default rates would probably all be relatively similar. Mm-hmm. And that's because private credit hasn't really been through a downturn yet, right? The advent of the class when it really started booming was maybe 10 years ago.
Right.
I think COVID was too short. I think what you're seeing right now also is defaults will likely rise because a lot of these borrowers put in capital structures when it was a zero interest rate environment, which is, now it's higher for longer. And I think that's why you're seeing defaults and some cracks emerge.
Does it get worse though? Because you're right. An investment in a zero rate where money costs nothing is very different from where we are today, right? It's just the business dynamics and the financial dynamics of a deal looks very different. So do we see more cracks going forward? Is Jamie Dimon right that there's never just one cockroach?
I think you likely will see some cracks, but what will be dependent is the cracks have been masked. The cracks have been around for a year or two. There's a lot of liquidity in private credit. And even in private equity, they weren't necessarily deploying in new investments, but they were helping the existing investments.
Forgive me but when does too much liquidity, though, become a problem where you're chasing after, there's so much more folks involved in the private market world, private credit, private equity. And when there's a lot of money around, it's like people are chasing deals and maybe more likely to take on even more risk. So when does it get messy, or does it not in this world? Maybe it's something different.
I think right now what you're seeing is there's still a supply-demand imbalance. As you had mentioned, there's less exits, there's less M&A, and so private credit dry powder has increased. But if we were to look at kind of the exit pace that private equity needs to do, M&A should increase starting in 2026, and that supply-demand imbalance should lessen. But right now, what you're seeing is there's really an imbalance right now. And so you are seeing that competitive nature of private credit. And does that mean looser underwriting standards? A lot of time, yes.
We should note Howard Marks, the co-chairman, principal, co-founder of Oak Tree Capital Management, out just last month. It was in the beginning of November with a traditionally long memo about private credit. But in bold on the second page, he writes, "So no, I don't think this is necessarily the beginning of a trend." And by the way, it's called Cockroaches in the Coal Mine. It's not an indictment of the whole sub-investment grade debt market or the whole private credit market. Rather, it's just a reminder that the yield spreads people care about so much are there for a reason, because sub-investment grade debt entails credit risk. You agree this is essentially just part of investing in this type of debt?
Exactly. If you don't take on risk, that usually means that you're yielding something lower.
Right.
It goes hand in hand. And I think because we've been in such a benign market where you haven't seen a lot of defaults, et cetera, that's why people, I think, are surprised.
So then what are the products or what's the credit that investors should avoid right now? Like, how do you separate? Because another criticism, I guess you could say, is that there's not a lot of transparency necessarily with this type of investment. So then how do investors know what they should invest in and what they should stay away from?
Yeah, I think one of the things to look out for is one of the questions I think that we all talk about are valuation marks, right? Is there transparency? Is there not transparency? I always tell people to ask them, what is your valuation methodology? How often are you looking at your valuation? Because in the end, we are in a private illiquid market. There's no mark to market. There is no market. And so there is a subjectiveness and a judgment on the manager. And I think a lot of it is, do they mark their investments aggressively or are they conservative?
Right.
How do you know?
I think you have to ask your questions of what methodology do you use? Discounted cash flow? How much does current yield matter? What does your recovery rates look like?
This is what Shri wrote about last week.
Well, yeah, yes. But this is where, like, I think about, Christina, that a firm, whether it's Oak Tree or somebody else, right? If you're playing games in terms of valuations or not being so transparent or whatever for your investors, the deals aren't going to pay off, right? And investors are not going to give you any more money. So is that kind of a checks and balance in some way in terms of ensuring you guys are doing the work, like they trust a manager?
Yeah.
And that you guys are making sure you have the transparency before you go into a deal.
Exactly, because if you are way too aggressive and all your marks are overinflated, you will have a really hard time with your investors.
Right.
Right. That is reputation risk. And also just inherently as a creditor, you are always worried about kind of what's next, what's the next risk, because your upside is getting what's contractually due to you.
Right.
So a lot of, just inherently as a credit investor, you tend to be conservative.
Because that's why some, and some of the conversations we've had in trying to figure out, like, are there more cockroaches out there? That maybe some of what some have said is smaller players that maybe don't do as much homework or something. That's where we might see some problems. Talk to us about the market overall, where you guys are finding opportunities right now, and what kind of opportunities. And I'm curious if it tells you kind of what this investment environment. Is it a healthy one? Is it a stressed one? Like, I'm just curious.
I would say right now there's a supply-demand imbalance. So what does that mean? It's very competitive. If you think about the first 9 months of the year with the tariffs, right? With all of the uncertainty, M&A went to a screeching halt for the most part. Now M&A has kind of come back after Labor Day. And so now you're seeing what I call a little bit of FOMO, where you're seeing a lot of lenders rush to get deals done. And I think this is the time that you want to be very selective. You want to be a credit picker because the terms are getting more aggressive. Leverage is going up. Pricing is going down. And so from like Oak Tree's philosophy standpoint is you really need to be selective. It's a yellow light. Proceed with caution. You're not going to stop investing, but you've got to pick and choose your spots.
Do you think this type of asset class will end up in the 401ks of many Americans?
I think that is, I call it the next frontier. I think from a technology standpoint, if you think about private credit, it's a relative, I'm talking about more sponsored direct lending. It's a pretty mature asset class at this point.
Right.
Right. And I think where you're going to see innovation is what I call technologies on reaching new investors or fund construction. And so I do think 401ks will be the next horizon, but that's also where private equity is also going into, right? And so will that help a little bit with the supply demand balance?
Yes,
Probably.
Right.
Whether people want it or not in their 401ks, I don't know.
Well, it does, though. It creates another demand, right?
Yeah.
For what's going on there. Just got about a minute left. Can you share with us, I don't know, an interesting deal that you recently did? I don't know how specific you can get, but just give us an idea in terms of maybe the type of deal, terms, or whatever you can share.
Just not about a specific deal, but just what we're seeing in the market right now is it's counterintuitive, but as the interest rates go lower, you're seeing leverage creep up because borrowers can actually make their interest charges now. And so before, when interest rates were, say, 4% on SOFR, you didn't really see deals go over 6 times.
Yeah.
Because otherwise, a borrower couldn't pay their interest. Now it's actually going the other way where you're getting lower yields but higher leverage. And that just notes the level of competition. So we're hoping that 2026 there will be a little bit more balance in deals.
Yeah.
But that's what we're seeing in the moment.
So does this assume, too, that you think the Fed will continue to cut rates even into 2026?
I think it all depends on who gets appointed.
You really
What about Kevin Hassett?
So, yeah, do you think, is it a dumb thing that if it's Kevin Hassett that you can assume that there'll be lower rates? Just got about 30 seconds.
I'm not going to make an assumption around it, but we all have an understanding of what the administration wants is lower rates, right?
Interesting times,
And
right?
we'll see where the underlying economy also says, well, hopefully we'll also dictate where the rates inevitably land.
Right, that the Fed sticks to the mandate and what needs to be done. Thank you so much. Really appreciate it. Christina Lee, Managing Director and Co-Portfolio Manager for U.S. Private Debt Strategy over at Oaktree Capital Management, joining us right here in our Bloomberg Interactive Broker Studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So our Bloomberg Intelligence team writing earlier today that holiday retail sales appear to be off to a good start despite mixed store traffic. There's a bunch of metrics coming at us. You have Retail Next coming out saying visits to malls were soft, down 3.6%. MasterCard saying Black Friday's online and in-store sales rose 4.1%. Salesforce says global online spending will increase 8% to reach $53.7 billion, while U.S. spending will rise by 4% to $13.4 billion. And then there's Adobe Analytics, Tim.
They noted a sharp 9.1% acceleration in digital sales as consumers leaned into the ease and convenience of buying online. Well, someone who knows how to read through all of these numbers, she does her own in-depth research too. She understands the retail industry. Dana Telsey is back with us, founder, CEO, and chief research officer of Telsey Advisory Group. She's been joining us here at Bloomberg quite a bit, Carol, going back to Black Friday.
She was here Wednesday,
She was
Friday,
here Wednesday.
today.
She's here on Cyber Monday.
Thank you.
She joins us here in the studio today.
Thank you for having me. There's a
We
lot
love
to
having
talk
you.
about.
I think you have a desk with your name on it
Yeah,
somewhere here.
it's easy. Thank you. And convenient to my office.
We love. There are so many different metrics that come at us. Is there a metric that catches your attention more than most, or is it that you rely just on kind of the work you guys do?
I rely on what we do, but I also look at all the metrics to tell a story. And frankly, what you're seeing the metrics tell the story of, essentially it was solidly optimistic for this upcoming holiday season. They're good metrics. A lot of the metrics surpassed their expectations. The other thing, when you look at online versus in-store is always going to be lower than online because online is a smaller part of the business. But one of the differences this year is online sales, the rate of growth slowed. It's going off a bigger base. While you're looking at in-store, the rate of in-store sales increased for some. Traffic is holding steady with what it's been year to date. And I think, for whatever you want to say, the Gen Zers, the teens, they like that experience of being in stores. That's what I saw on Friday when I traveled all the stores.
What do you mean by that? Like, this is like the same people who watch Friends, ironically, because they, didn't watch it the first time around, are now going to the mall? Like,
the teens are going to the mall
that's what
also.
I mean.
Everyone wants the experience. I think what everyone missed from COVID, talking to each other, saying this looks nice on you or look at this deal, that communication matters.
So what's old is new again, Carol? They're going back to the mall just like we did when we were kids.
Well, I know. Who doesn't love a mall? I don't love a mall anymore. Having said that, though, Dana, like my daughter, 22, there was something she was going to buy online, but we went to Bloomingdale's to try it on, and she ended up like, okay, this doesn't work, and not buying it. So it's like interesting, kind of this mix of how we're figuring it out of how to shop.
And it's always the surprise, because when you buy something you've had before, maybe you do get the same size or you know what it is. When you're buying something new, and one of the things this year is there's newness to wardrobing. You're looking at shoes where people are going back to whether it's brown suede boots like Steve Madden is selling, whether it's wide leg denim jeans. It's not just the same old, and partially because events are taking place.
So we look at retail sales as this monolith, but we know that's not the way that they're actually sliced. What would you say characterizes the companies that are doing a good job at actually bringing consumers through the door versus the ones that are not?
Newness. I think the newness and product innovation really matter, something that they don't have in their closets. You think about the newness even in consumer electronics, whether it's Nintendo, whether it's Aura rings, there's new things out there. Same old, you're going to watch for the deals and what the value you're getting. But today, when you have, whether it's Coach adding new items to their Tabby collection, whether it's Macy's, who now has 40% newness, 20 new cosmetics brands in their stores, whether it happens to be Steve Madden, which I mentioned with the brown suede boots, the closed-toed shoes at Birkenstock, or you look at Levi's, which frankly has new collaborations that's driving demand. So what are you showing me this year that you didn't show me last year?
What about promotions? Because I have to say, leading up to it, I saw some big promotions, 50, 60, and they built through kind of the weekend.
So we do a tracker, 85 retailers that we track every holiday. We've been doing it for over 10 years. We did see promotions build, particularly in some of the specialty apparel retailers, but not everyone.
Yeah.
And we saw some promotional increases, whether it's the Bath and Body Works we saw it in, and you've seen a wider range of promotions instead of maybe last year 40 to 50, maybe it's 40 to 60%. You're going to watch that. At the same time, you know who had fewer promotions or less promotion? Ralph Lauren. 30% off instead of 40% off last year.
So what's the picture that all of this paints of the consumer?
I think it paints a consumer who's a bifurcated consumer, higher income continuing to spend, lower income basically being very discerning in what they're spending on particularly on essentials. But it's also showing consumers want to celebrate the holiday season, and they'll think about January and they'll spend for holiday.
How much, though? I think about this a lot. I mean, how are they buying? We saw some information about the buy now, pay later, continuing to be an important payment option for consumers. Adobe forecasting $20.2 billion will be spent through the payment method this holiday, 11% growth over 2024.
I think on the buy now, pay later, look who it's going after. It's going after those consumers who have more limited spending power, and it's picking up interest. You are seeing companies who've had buy now, pay later for a long time. It's still important.
It's everywhere now.
It is everywhere. So it's not as differentiated as it had been in the past.
It's not a sign of anything in your view?
No, I'm watching credit card delinquencies a lot. We're looking to see what that looks like. We're watching certainly what consumer spending looks like. And if anything, you're still seeing some pretty solid results. Take a look at the retailers' earnings the past few weeks. While they've been mixed, some of the outliers, I mean, who would have thought Kohl's basically showed some improvement. And we've seen some good results. More to come this week, because this week everyone from Macy's, Victoria's Secret, Ulta, Signet are all reporting, and we'll get some more color on discretionary.
So it feels pretty good.
It feels
okay.
Tariff-driven price increases. I mean, the demand elasticity is something to be watching carefully.
So that's definitely there. Like, does it feel like a season where folks were like, holidays are important, and so I'm budgeting so that I can spend here, and maybe I won't do something else?
I think there's some of that, but I think they're also spending, saying I'll pay it back later. I think they want to celebrate, given it's been a tough year with a lot going at consumers all at the same time.
So you said that Nintendo has done a good job this year of bringing consumers through the door.
Yep.
Companies including Steve Madden, Levi's,
Ralph Lauren.
What are the hot products as we look to December?
You have to say Labubu.
Oh, Labubu is the hot product. Oh, yes.
Okay.
It is. I don't even know what a Labubu is. It's like a little...
It's a collectible
thing on a backpack.
Collectible. Yep. It could be on handbags, backpacks. Guys and girls wear Labubu or have Labubus, and it is the hot
Do you
thing
have
now.
a Labubu?
No, I don't.
Okay,
Do you?
just checking. No, I don't. No, but it's just kind of
Well,
wild.
now I know what I'm getting each of you for the holidays.
Thank you.
Is there like an it thing? Is that
That is the it thing. The
Yeah.
Labubu is the it thing. I mean, there's other things out there that are certainly trending. Legos are always trending and are very popular. So who can't take that away?
Yeah.
When it's gotten colder out, so you're definitely seeing sweaters and outerwear take center stage.
Ah, love it. Dana Telsey, founder, CEO, and Chief Research Officer of Telsey Advisory Group.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.